with Carr, and Ingram. He serves primarily internal and external audit clients. He does publicly traded banks and privately owned banks, so he's got extensive experience. He also does various consulting with regulatory agencies and advises our clients relative to merger and acquisition activities and due diligence. You can see from his professional affiliations that he has a lot of activity in not only professional affiliations but also charitable and civic also. Glad to have him leading our webinar today. And again, I'm Phyllis Ingram. I'm one of the founding partners of Carr, and Ingram, based in Montgomery, Alabama. So just glad to be the moderator for today's session. Just a few housekeeping comments. If you're attending and you want to get the CPE credit, you have to be logged into the webinar for the whole entire 50 minutes, and you need to answer the polling questions. You don't have to get the polling questions correct, but you need to answer those. And you'll see on the screen that you get 1 hour CPE credit, and then certificates will be emailed 24 hours after the session. And if there's any questions about the certificate process, you can email that to marketing@cricpa.com. And then a note at the bottom, you'll see that the PDF handout of the slides will be emailed within 24 hours also. So here's today's agenda, and with that, I'll turn it over to Doug Mims.
Okay, thank you, Phyllis. Well, good morning and welcome. Appreciate you all joining us. We are today we're going to cover the draft interagency statement that's currently out, and this is our third CECL webinar. It's the third in our series, so we affectionately refer to it as CECL 3. But today we're going to cover just the interagency statement, not so much in the standard, and kind of hopefully give you the Cliff Notes version of what's out there. We'll start out with a little background and overview of ASC 326. We'll cover the scope of the interagency policy statement. We'll talk about the measurement of ACLs. We'll talk about the measurement of ACLs for AFS debt securities. We'll go through documentation standards, which is very significant in this document. Analyzing and validating the measurement of ACLs. We'll talk about the board's responsibility, management's responsibility, how the examiners are going to approach the review, and then talk briefly about some next step and closing thoughts. So this is kind of how the interagency guidance is structured, so we're kind of going in lockstep with that. So I'll say this, the interagency guidance was issued, I believe, in October, and so we plan to have we started the planning process for our webinar. I really thought it might be final before we actually got to the point of having our webinar, but as of today, to my knowledge, I have not been able to determine that it was issued final. So we are speaking with regard to a draft document, which means obviously it could change when it goes final. So just please keep that in mind, and we'll certainly take a look, and if there's significant changes when it goes final, we might give us a reason to have CECL 4. So just a little bit of background and overview. So ASU 2016-3, topic 326, issued a number of years ago, and it's gone through several iterations, as you know, and we kind of landed with, as of right now, the largest banks and SEC registrants, larger SEC registrants are a go for having to comply with CECL now, Q1, and then prospectively, most of the people on this phone, hopefully everybody on this call, because if you're going Q1 and you're on this call, we might have a problem, but hopefully everybody on this call is planning and set up to go in 2023. So that's kind of where we are, and I think everybody probably knows by now, but CECL is essentially moving from an incurred loss model to a more forward-looking model under the CECL methodology. So topic 326 will be, when I reference that, we're referring to the standard. And I will say this, the regulatory guidance refers to topic 326 throughout the document. So they've made a concerted effort to be consistent with the standard. There's a couple of places where I'm not sure if we're going to have a wrap gap difference or not. And I'm interested to see how that comes out in the final version, but I'll point those out, and I don't think they're significant but I do think there is a thought process there. So topic 326 and this interagency statement applies to all financial institutions, all banks, savings institutions, credit unions, financial institution holding companies, regardless of size, that file regulatory reports for which the reporting requirements conform to GAAP. So, end of the day, no matter what your size, if you file a call report and that's supposed to be in conformity with GAAP, then you are subject to this interagency statement. And I'm assuming everybody knows this, but an interagency statement is when all the regulators agree. So it's when the Fed, the FDIC, the OCC, the NCUA, as well as the state regulatory body that represents all the states, agree on something. And so this is an FFIC statement, so there's collective agreement. The statement, as I mentioned, is maintaining conformity with GAAP, and there's a concerted effort to do that. And I will say, as I've said in prior webinars, everybody's been at the table. When there's been, FDIC has done their webinars and all those things, all these agencies have been represented, as well as the SEC. So everybody appears to be on the same page as to what the expectations are, whether it be the FASB, whether if you're a SEC, smaller SEC registrant, whether you're a national charter, state charter, everybody is asserting that they're on the same page. So I actually jumped ahead and talked about the applicability on the previous slide, and then the policy statement is effective at the time that you adopt topic 326. So at the point for financial reporting purposes that you decide to basically to adopt CECL, at that point this interagency statement would be effective for you. Otherwise, it's not effective until January 1 of 2023. This statement supersedes several previous statements that we've all been operating under. Not only you all have been operating on it largely on a daily basis, actually living in it, and we have really audited to it because it's been a supplement to authoritative guidance and largely consistent. But the interagency policy statement on the ALLL, you will notice is the allowance for loan and lease losses is no longer the concept, is the allowance for credit losses. So it's the ACL, not the ALLL. And then there's these policy statements that related to the ALLL, the one from July of 2001, the one from December 2006 for banks, both are superseded by this. And then the NCUA put out a separate policy statement, 02-3, which I think was largely either identical or very similar to these other two in May of 2002, and that statement would be superseded by this FFIC guidance. So one point of note is rather than updating the agency's guidance on loan review systems as part of this, they're currently developing separate standalone guidance on expectations for effective credit risk management. So we'll see in here the document does refer to credit risk management in different places, but it doesn't necessarily robustly and holistically address credit risk. It's very much in line with just how you apply CECL. So the scope of the statement, and then in this context, when I say statement, it's the interagency statement. I guess I'll try to differentiate and say 326 when I'm referring to the FASB statement. But so what's in scope, and I'll go through these quickly because I think most of you know these. If there's any that kind of caught me as interesting, I'll mention them. But this is consistent with the standard. I guess I'll call the 326 the standard. We'll call this the statement to the extent there's any differences. So finance receivables such as loans held for investment are in the scope. Overdrafts are in scope. Held to maturity debt securities are in scope. Receivables related to revenue that's within the scope of topic 606, which is certain fees and other things, and we won't get all into that. That gets fairly complex. Most community banks, it's not a big deal. So most of the folks on this call, 606 was a non-event, and therefore the receivables associated with them would not be a big deal either. Certain reinsurance recoverables are included. Receivables related to repurchase agreements and securities lending agreements within the scope of Topic 860 on transfers and servicing. Again, that's probably not applicable to you all. Off-balance sheet credit exposures, including commitments, standby letters of credit, etc., not including derivatives. So I will focus on that just a little bit. I think some folks were unaware that off-balance sheet credit exposures were in the scope of CECL, and they are. So keep that in mind, because that normally applies to everybody, particularly even small community banks. It does not apply to the following financial assets. Financial assets measured at fair value through net income, which we don't have a lot of those in community banks and small credit unions. AFS debt securities, that's a little misleading because there is a subtopic that we'll cover in this. So 326 directly doesn't cover it, but subtopic 30 does, and we'll address that. Loans held for sale are not in the scope of CECL. Policy loan receivables of an insurance entity, loans and receivables between entities under common control. So if you happen to have a loan between sister companies, so if you had that, then those would not be in the scope. Receivables arising from operating leases, which with the lease standard might be relevant. So those are outside the scope. Okay. Oops. Okay. So we're on a poll question, Phyllis. I snuck up on you.
Thank you, Doug. That's some good information. So we'll start with our first poll question. And remember, to get the CPE credit, you need to answer the poll question. Doesn't have to be right, but just make sure you answer it. So our first poll question is, CECL methodology is not applicable to available for sale securities. So if you would just answer that true or false and submit your answer, then we'll see how those are coming in. Okay, we'll wait just a couple more seconds. Doug, the first few slides have been very interesting, so thank you.
Sure.
So we'll close the poll. And so the answer was true. So that is correct. The majority got the correct answer, true.
Very good. Thanks, Phyllis.
Thank you.
Okay. So we'll talk a little bit about measurement of ACLs. Overview of ACLs, there will be a valuation account deducted from or added to the amortized cost basis of financial assets. That's the same thing we do today. Represents the net amount expected to be collected over the contractual term. Quite frankly, that's largely what we do today, but we'll get there a different way. Estimation should include consideration of past events, current conditions, and reasonable and supportable forecasts. So estimation in today's environment includes, typically at a community bank or credit union today, includes past events, meaning our historical losses, and current conditions, which is our qualitative factors today. So in today's methodology, two of the three parts we're doing, the part that's new, if you will, is the reasonable and supportable forecast. So that's where we're headed. It requires management to use relevant forward-looking information and expectations. So only if it's relevant. You don't have to consider everything, and we'll talk more about that. And ACLs are to be evaluated at the end of each reporting period, which I'm interpreting to be quarterly for most everybody. I think there's a caveat for credit unions that would be quarterly or prior to paying a dividend. The methods used to estimate ACLs should be applied consistently over time. And again, this is straight out. This is not of the standard. This is out of the statement, but it's very similar. Changes to ACLs via periodic evaluations are recorded through increases or decreases to the provision for credit losses. So instead of the provision for loan, same thing we do today. Provision for loan losses is now PCLs, provision for credit losses. So we'll have to get used to that. Specifically identified uncollectible amounts should be promptly written off against ACLs. Again, it's what we do today. Estimation of ACLs involves a high degree of judgment and is inherently imprecise. I think we all know that too. So we're living in that world today. May result in a range of estimates within the best estimate being supported and recorded. I think that is important. We'll see it again where it talks about a range of estimates. I think most community banks today come up with a number, and maybe the range comes in when you have an unallocated reserve. Maybe that's kind of your range, if you will. But there is definitely an expectation that you might not land on a number, and there's an acknowledgement of the imprecise nature of the exercise. So collective evaluation of expected losses. So there is a requirement. This is required for losses to be evaluated on a collective or pool basis when you have financial assets that share similar risk characteristics. This is, again, the standard and statement align on this, and we've gone over this in our prior webinars. But so for most community banks, smaller, less complex community banks, which are most of you, call codes are going to be relevant, and call codes should be considered. That doesn't mean you have to use them, but if that works today, I think you need to ask yourself, why wouldn't that work prospectively? Is there a reason it wouldn't work? And these are some examples, and this is not in the standard that I recall. So this is in this statement where they give some examples of how you could group: collateral type, size, effective interest rate, term, geographic location, industry of the borrower, quick on the trigger there, or vintage, which means when the loans were originated, which would be challenging. But so collateral type, size, effective interest rate, term, just some things that you could do. I think today, call codes kind of align with collateral type, so that's what most folks are doing. So it's certainly acceptable to continue doing that. Topic 326, the standard does not prescribe a process for segmentation, meaning it doesn't mandate you do it a certain way or that you group things a certain way. And it does require that you evaluate on an ongoing basis how you're pooling. And that's consistent. That's in topic 326, and it's also mentioned in this statement that not only do you segment, but you need to continue to evaluate it on an ongoing basis. And we'll talk a little bit more later, but that means you got to document how you continually assess it. Everything's about documentation, and we'll talk about that further. Financial assets that do not share similar risk characteristics with other assets can be evaluated individually. Now, that's not what we're doing today. That's not the same as an impaired loan today. An impaired loan is isolated and evaluated separately because of the deterioration, the fact that it is impaired by definition. This just means if you have a loan or loans that don't fit anywhere, you can evaluate them individually. But if they fit somewhere, they need to be in a pool. So estimation methods. The 326 does not require the use of a specific estimation method. They reference several different kinds, and this statement does as well, and we'll mention those later. The same loss estimation does not have to be applied to all financial assets. So you can use a different estimation method based on the pool, or other. If it was a one-off, if you pulled one out because it didn't have any comparability and you used a different loss estimation, that's acceptable. And here's some of the accepted methods: probability of default, roll rate method, discounted cash flow method, a method that uses aging receivables, or other reasonable methods. So I think it's trying to, a method that uses aging receivables, I think it's speaking to a smaller, less complex institution. It doesn't come out, again, it doesn't come out and say, hey, you use the warm method, but they've all but said that. So when you think about call report codes, and you think about your institution, and you think about what method am I going to use, there's not been an endorsement of using your call codes in the warm method, but it certainly has been discussed a lot. Methods selected should be appropriate for the financial assets being evaluated and be consistent with the institution's size, complexity, risk appetite, etc., which makes sense. A little discussion about the contractual term of financial asset. The topic 326 requires the loss to be expected loss to be measured over the contractual term of the financial assets, including the consideration of expected prepayments. So you would have to estimate prepayments. Renewals, extensions, and modifications are generally excluded. So that's a little bit of a twist, but renewals, extensions, modifications are generally excluded. prepayments have to be estimated, and the exception is when you have when you have the reasonable expectation, which is not defined herein, a reasonable expectation of executing a TDR. So if you have a troubled debt restructuring that you expect to happen, you can consider renewals, extensions, and modifications. And we're to another poll question.
Thank you, Doug. So we're up to our second poll question. So we'll launch the poll, and it's the same loan loss method has to be consistently applied to all assets, true or false. So if you would answer that. And Doug, I love your poll questions of true and false versus a multiple choice are much easier. So our participants have a 50-50 chance of getting the answer right. And it's easy to read too as a moderator.
Exactly. It's easy to come up with them.
So the results are coming in, so we'll wait just a couple more seconds. Remember, you have to answer the poll question to get the CPE credit. So we'll close the poll. And the answer is false. So we got 92% got the correct answer. So Doug, you're doing better on that second section.
Well, good.
So great. So continue on.
Okay, thanks, Phyllis.
Thank you.
Okay, so a little discussion about historical loss information, and I'll keep saying this. Everything that we've talked about thus far, everything I've been going through is in this interagency statement is consistent with topic 326. So, and redundant with that. So if you've been on a prior, we're not talking about anything new on here. Historical loss information generally provides a basis for an institution's assessment of credit losses. So there's a little bit of encouragement there. Certainly you would consider historical losses as your past events. In some respect, that doesn't mean you don't adjust them, but that means that they provide a general basis. Historical loss information can be based on internal or external information or a combination of both. You should consider the need for adjustment based on your current asset characteristics, such as underwriting standards and portfolio mix. So you should consider adjustment based on your current asset characteristics, examples of which are underwriting standards and portfolio mix. And the implication obviously there is you would continue to evaluate that because those may or may not change. Further adjustments should be considered relative to current conditions and reasonable and supportable forecasts to the extent that they differ from the conditions that existed during the historical loss period. So if today your current conditions, as well as when you look forward, you're reasonable and supportable, if today those are different than your historical losses, then you need to adjust your historical losses. So is there ever a scenario where you could say, hey, everything's the same today as it has been for the past 5 years, and looking forward, it looks the same to me, and we're just going to use our historical losses? The answer to that's probably no, right? I mean, nobody's doing that today. We're all rolling up our sleeves and trying to support our qualitative factors today, so that probably won't work. But it's also probably not true because obviously a lot changes over a period of time. Adjustments to the data may be qualitative or quantitative in nature and should reflect changes to relevant data, such as unemployment rates and delinquency. So again, referencing relevant, and what they really say, and it may say it on another slide, I may be jumping ahead, but you don't have to consider everything. All information out there is not relevant. Just because it's out there doesn't make it relevant to you and your institution and the risk characteristics of your portfolio. So you don't have to consider everything, but if it's readily available and relevant, then you should consider it. So a little bit more on reasonable and supportable. Topic 326 requires management to consider forward-looking information that is both reasonable and supportable, relevant to the collectability of cash flows. I think everybody knows that for the most part. It may extend over the contractual term or a period that should be shorter than the contractual term. So again, prepayments have to be considered. But as a general rule, you use the contractual term unless you think unless you can establish an estimate for, there's likely a prepayment. Forecasts may vary by portfolio segment or individual forecast inputs. So you can actually do this. You don't have to do it in the aggregate. Your forecast can be by portfolio segment. It could be by loss pool. It just depends on how you want to do it. That varies today. We have folks who consider like qualitative factors for the current conditions. That's considered by pool by some of our institutions. It's applied by pool normally, but it might be considered on the whole and then applied to all the pools. It just depends. So you just have to consider the makeup of your portfolio. And this is where it's not required to search all available information or incur undue cost and effort to collect data. Multiple economic scenarios can be considered but are not required. So a little bit of extra verbiage in this statement than there is in the standard to say, simple. Just if you try to find the path of least resistance and do something that's reasonable. 326 and this statement do require you to revert to historical loss information or an appropriate proxy when the contractual term of an asset, or we'll just asset pool, extends beyond the reasonable and supportable period. So if you've got a contractual term on a pool of assets, or we'll just say an asset, and it extends beyond what you think is reasonable and supportable, then you can revert. You can use a reversion method and revert to historical losses. You can do that for each individual input or the entire estimate of loss. So if you deem it appropriate. You also don't have to revert if you think your data is okay and you think you can, if the contractual term doesn't extend beyond the reasonable and supportable, you don't have to revert. But I think there'll be some reversion in everybody's calculation. No specific reversion technique or period is required, and there are reversion techniques are not an accounting policy election and should be evaluated each reporting period. So what they're saying is if you do deem you have to revert to historical loss, because again, your contractual term extends beyond the reasonable and supportable, then it's not and this is important because we're going to talk about accounting policy elections later. This is not an accounting policy election. It doesn't have to be documented as such. So it's more like an estimate, and it'd be a change in estimate. So you would just reevaluate periodically, and if you deem you want to change your reversion method, then you do it, document why, support it, and it's not a significant change in accounting policy or practice. So historical credit losses generally do not, by themselves, so this kind of goes back to what we were talking about a moment ago, generally by themselves form a sufficient basis. So you can't most likely just use historical losses. You should consider qualitative adjustments. You may increase or decrease the estimate of loss, and adjustments should not be made if information is already considered in the loss estimation. So if you've already got it factored in somewhere, don't double dip. And there's always a risk of that when you're using qualitative factors and other things. Here are things that you should consider, and I put should on purpose because you're not required to consider them. Nature and volume of financial assets, concentration of credit. Let me back up. So this is key factors. I kind of jumped ahead. I'm not reading the top of my slides. I'm trying to look at the content. So these are key factors. So you should use qualitative factors. You can't just use your historical losses. So we know that. And so today, I think there's 9 in the old statement that we've all been following. The old statement had the 9 environmental factors that everybody's used as a basis for their Q factors. Well, this is me. I guess paraphrasing. I don't know what the official buckets will be. This will be close. So the buckets you use today for your Q factors, these are what they are in this proposed statement. The nature and volume of financial assets, concentrations of credit, volume and severity of past due, non-accrual, and inversely classified assets, value of underlying collateral for loans not collateral dependent. So we'll talk later in the slides about collateral dependent loans. So for non-collateral dependent loans, you would consider the value of the underlying collateral. Collateral-dependent loans they're different, okay? Lending policies and procedures, any changes in underwriting, collections, write-offs, recoveries, the quality of your credit review function, the experience, ability, and the depth of your management team and staff, external factors including regulatory, legal, technology, competition, and natural disasters. Actual and expected changes in economic and business conditions, and there are additional Q factors, because this all relates, and I probably should have said this before, this all relates to debt securities too. So there are additional Q factors that you may consider for debt securities in addition to the ones above. So just to run back through these, so nature and volume, concentrations of credit, and you can see these others. So a little different, very similar to what we have today, but a little bit different, and maybe a different number of buckets, if you will. So that's the Q factor adjustments under this FFIEC statement prospectively. And we're to a poll question.
Okay, great. We're to our third poll question, and we'll go ahead and launch the poll. And the question is, historical losses should not be adjusted under CECL. True or false? If you'll take a few minutes to answer that and submit your answers. We'll wait a few seconds before we close the poll. So we'll go ahead and close the poll now. And that answer is false. So 66% got the correct answer. So great job, Doug.
Good. Thanks, Phyllis. Okay, so we'll forge ahead. So a little bit of Q factors, and then we'll go into what is a collateral-dependent financial asset. This is the one where I'm not sure if we've got a wrap gap difference. So if you have a financial asset for which repayment is expected to be provided substantially through the operation or sale of collateral, there's not a definition of expected, so we're going to need that at some point. They also use the phrase reasonable expectation, which I pointed out earlier. I think I need to look back at the standard, but we'll need some guidance and some clarity on that. But if you expect, whatever those criteria are, if you expect that you're going to, the only way you get paid back is through collateral, then it's a collateral-dependent financial asset. Then there's an emphasis, and there's also a footnote and a drop down there. For regulatory purposes, the ACL is measured using the fair value of the collateral regardless of whether foreclosure is probable. Again, I don't know if expected is probable, and I probably should know that, but I didn't see any guidance on that, and we'll work on that, and all of us can. Yeah, I think there'll be some guidance about that, and there may be something buried in 326 now, but expectable, probable. So if what they're saying here is that for regulatory purposes, it doesn't matter if it meets the threshold of probable, which we do have that guidance. I guess I should say we have that under current standards. We know what probable is. So, but if you expect, then they expect it to be valued at the fair value of your collateral. And I think what the point of emphasis is there could be a scenario where you have a loan that doesn't quite make it to collateral dependent under the standard, under GAAP, but for regulatory purposes it does. And then you might have a wrap gap difference. I think this is what the point of emphasis and what it's leading to. But for now, just know this: collateral dependent financial assets, meaning if, hey, the only way I'm getting paid back is if I foreclose, then those need to be valued at fair value less cost to sell, which is what we do today with impaired loans. Increases and decreases in fair value should be recorded through the ACL, with any negative ACL capped at the amount previously written off. Meaning once you establish your ceiling, you say, and when you bring it in, and it can't be written up above where you are. So if you bring it in at $10, that's your new cost basis, just like it is today. You establish that. And if it declines in value, then you would recognize that. If it declines to $8, you'd recognize the $2 as a reserve. If it goes back up, you can write it up. You can never write it up against above $10. That's the same thing we should be doing today. In fact, most folks, when they foreclose, nobody wants to write up a foreclosure. So we actually have a little bit of a wrap gap difference sometimes because we still bring those in at the lesser of fair value or the loan balance, and that's actually not GAAP. So very similar to what we do today, but potential wrap gap difference. TDRs. Expected credit losses on financial assets modified in TDRs are reasonably expected. So we mentioned it in relation to TDRs earlier, but again, that phrase reasonably expected to be modified in TDRs or estimated using CECL. So under current guidance, I think there's three methods, might be two, but there's some methodology in and around how you value a TDR. And I believe there are three methods today. I don't know why I'm drawing a blank on that, but it's two or three. Nonetheless, that's under this methodology, a TDR or a reasonable expectation of a TDR, you should value it under the CECL methodology. Losses related to collateral-dependent TDR should be estimated based on the fair value of the underlying collateral. The estimated effect of reasonably expected TDRs may be included in an institution's Q factor adjustments. So let me say that again. If a loss is related to a collateral-dependent TDR, then it should be done the same way as any other collateral-dependent loan. It should be at fair value, less cost to sell. The estimated effect of reasonably expected TDRs may be included in an institution's Q factor adjustment. So if you have a TDR, if you hadn't done it, you reasonably expect that you will have a TDR, it's in process, whatever, then you can actually adjust for that through your Q factors, I think, until you actually do the TDR, and then you'd need to record it at fair value. But your estimate would be at fair value either way, I believe. Okay. Accrued interest receivable is also in the scope, and this is the accounting election I was talking about. So accrued interest receivable should be included in the amortized cost basis of the asset, and it generally should be written off against ACLs, generally. There's three independent accounting elections that you can make at adoption. One is you may elect to measure via ACLs if uncollectible interest is written off timely. You may elect to write off by reversing interest income, use of PCLs, or a combination thereof, or you may elect to present accrued interest receivable separate from the financial assets on a net basis. So you got three options, not to belabor the point, and I probably said that too fast, but there's three ways to do accrued interest, and you've got to make a formal election. I don't think it's going to change the way most of us look at it today, but you can include it in the amortized cost, or you cannot, and then there's a hybrid in the middle. So you just have to make that election and just be aware of that. And my guess is most folks will do what they're doing today. Off-balance sheet credit exposures, I mentioned previously, those are in the scope of CECL and need to be reserved for accordingly. It requires estimation of credit losses associated with off-balance sheet credit exposure. Estimates, they should take into account, this is an estimate. Again, you got to document this. So estimates should take into account the likelihood of funding, as well as the amount expected to be funded over the contractual term. So if you've got an off-balance sheet exposure, and you should take into account the likelihood of funding, as well as the amount you expect to fund, because you might not actually expect to fund it all. So that's an estimate that you'd have to evaluate and document. And you shouldn't record credit losses for exposures that are unconditionally cancelable by the issuer. So if the issuer can cancel it, then you don't have to record a reserve. Estimated credit losses are recorded as a liability rather than in the ACL. So if you determine that based on the likelihood of funding and the amount expected to be funded, and when you evaluate it, you think you do have a reserve, an ACL to record, that should be done through a liability, not through your allowance for credit losses. Only for off-balance sheet credit exposure. Key point. Measuring ACLs, additional topics. I didn't want to, there's a lot of information. I mean, this is truly the Cliff Notes version of this document, but I did just want to point out, purchase credit deteriorated assets are covered by the statement, but I won't go into it. It's consistent with the standard. Financial assets with collateral maintenance agreements is also covered, and financial assets with zero credit loss expectations. So it does, the statement does contemplate that you could have loans that don't have a credit loss, and those would be wish that was all of them, right? But nonetheless, that is contemplated in the standard and in the statement and covered. Okay, poll question number 3, I think.
4. Okay, this is our final poll question. So we'll launch the poll. Credit losses for TDRs should be estimated using the CECL methodology. True or false? So if you'll answer that and submit your answer, we'll wait just a couple of seconds. Doug, I'm glad we're sharing the slides too, because there's a lot of information on the slides that you prepared and presented. So, those will go out in 24 hours. I think that's going to be really helpful for our attendees to have that to reference back to. So I'm glad we're sharing those. Okay, we'll close the poll. Oh, and 84% said true, and that's correct.
Okay, good.
Okay, good. Turn it back over to you, Doug.
Okay. Actually, you answered the question correct before I covered the topic. I think I did a last minute adjustment to my polling questions. I got them out of order. So we'll cover AFS debt securities. Yeah. What I would say is, and Phyllis is right, there is a lot of information on the slides. I don't even think with a lot of information that it actually does the statement justice. I think it's very much the Cliff Notes version, but the reason there is a lot is so that you can refer back to it. So that's why we share them with you, and hopefully you can use them as Cliff Notes, and where you feel like you need to look at them a little closer, certainly that'll be an option. So this is well, actually that was held to maturity. The question was on held to maturity. Yeah, okay. No, I didn't get them out of order. Okay, good. So AFS debt securities, they are not within the body of 326, but they are included as subtopic 326-30, financial instruments, credit losses, AFS debt securities. So credit losses, again, we're talking AFS now. I was getting myself confused. So we're not talking about HTM. So credit losses for AFS debt securities should be evaluated when the fair value is less than amortized cost. So we're talking about credit losses. This is actually not different than the standard today. So we're talking about example, if you've got a debt security, and let's say it's a municipal security, and it is underwater, then you need to evaluate whether or not you have an impairment, if you will, and that's not the terminology. Do you need to record a credit loss related to the credit worthiness of the issuer? So is the city having financial problems, et cetera? You could evaluate and say, hey, this isn't a short-term dip. These folks are having problems. I have concerns about whether or not we're going to be able to collect, and you need to put a reserve up. So AFS debt securities is addressed by subtopic 30, and it requires credit losses to be calculated individually rather than collectively using a discounted cash flow method. So going back to the other discussion in 326, it's all about pooling and things like that, and it doesn't prescribe a specific method, right? But for AFS securities, you have to evaluate them individually, you have to reserve for them individually, and you have to use a discounted cash flow method. And you would recognize that through a charge to PCL. Now, that doesn't mean you wrote it off. That just means you have a provision and you have a related allowance. Subsequent increases can be recognized through the PCL to the extent not previously written off. So if you put up a reserve and you don't determine it needs to be written off, but you just have a reserve and it goes up, again, you've got a ceiling. You can't go above the initial ceiling is basically what it's saying. And that says that here, ACLs are limited by the amount that the fair value is less the amortized cost. So you have a fair value floor. So that's AFS securities. Okay, documentation standards. So policies and procedures for the systems, processes, and controls necessary to maintain appropriate ACL should address. So this is your written policies and procedures for the systems, processes, and controls necessary to maintain appropriate ACLs. This should be addressed in your written procedures. So if there's a section I really can't do justice to, via my Cliff Notes version versus what's actually in the statement, this would be it, because it's pretty robust. But you should address the processes that support the determination and maintenance of the ACL. You should address roles and responsibilities as well as segregation of duties. Segregation is mentioned several times. You should cover the processes for determination of the historical period, the same for your reversion techniques, as well as processes for how you arrive at what is appropriate pooling/segmentation, data capture and reporting systems. You should have a description of the systematic and logical loss estimation processes for determination and maintenance of ACLs. You should have procedures for validating and independently reviewing the loss estimation process. So validation and independent review, we'll cover that more in a minute. And the systems of internal controls used to confirm that your processes are maintained and periodically adjusted in accordance with GAAP. So we'll cover some of these, but I just want to stress the fact that your written policies and procedures are supposed to address all these things. You should have that document. And Siri just thought I was talking to her on my iPad, if y'all heard that. Okay. So that's documentation standards. So the actual analysis and validation of the overall measurement. So management should perform an ongoing, rigorous, and well-documented evaluation of ACL. Those evaluations can include, and they specifically put these in here. So I think these are what they're expecting to see for a smaller, less complex institution. Comparison of actual versus estimated write-offs, your actual write-offs, ratio analysis, and there's a bit of discussion. And then also it references peer group comparisons. I will say this about peer group. It says, hey, you can use this as a benchmark, but I would say that wouldn't be okay for it to be your only one. I think you need to do the other two as well. And they're a little leery of folks over relying on peer group comparisons. So they do mention it, but they kind of discourage you over relying on it. The estimation process should also be periodically validated by a party with the appropriate knowledge, expertise, and experience who is independent of the credit approval and estimation process. So your process needs to be periodically validated by somebody who knows what they're doing and is independent of the process. And these are all straight out of the standard. So these are requirements. They're not suggestions. Of course, it covers board responsibility, and this is the board's responsibility, retaining qualified management to review management's assessment of the loan review system. And again, this needs to be documented in their minutes, and it needs to be clear that this they use the phrase throughout this challenge, that they are challenging things. Annual review and approve loss estimation policies, the policies we talked about previously. Reviewing management's assessments of processes and controls over credit quality for investments. It specifically mentions investments. Review management's assessment of and justification for their ACLs and PCLs. Require management to periodically validate loss estimation. Approve audit plans, both internal and external. And review findings and monitor remediation. So they're expecting the board, and this is not unlike what we do today. There's just different pieces to it, and it'll be documented differently. I would say I think the documentation expectation as indicated in the statement seems to be more than what we do today. It seems to be quite a bit more. I don't think the board's responsibility is that much different. I would build this into their responsibilities because these are the specific things that it references, and make sure that it's clear that they're engaged in the process and that there is some challenging of the process, and that they're monitoring these things from a governance perspective. Management is expected to adopt and adhere to the written policies and procedures that we referred to previously. They're expected to maintain appropriate ACLs, both under, for GAAP and regulatory requirements, which hopefully are the same at the end of the day. to establish and maintain appropriate governance activities, periodically compare loss estimates to actual write-offs. We talked about that. Periodically validate the loss estimation process. We talked about that. And engage in sound risk management of third parties. Obviously, there's third parties involved, or could be. Even if you don't use a model, there may be other places where you're relying on third parties where you're pulling data. So you need to make sure they're subject to your third-party risk management processes, and make sure you document, who you're relying on, what you're relying on them for, and make sure your due diligence of that third party is appropriate and sufficient based on their role in the CECL process. The last area that's covered by the standard, so the standard, if you look back, the statement, it covers documentation standards. It makes it clear what it expects you to document. It makes it clear that really it addresses, designing, documenting, and validating. That's really what it does. And it says, and we expect you to capture this, and then here's how your board should oversee it. Here's how management should oversee it. You need to demonstrate that you're doing that. And then lastly, well, what are the examiners going to do? So they're going to evaluate these written policies and procedures and your estimation methods that we've talked about. They're going to look at board oversight as well as management's effectiveness in managing credit risk. They're going to review overall levels of ACLs. There's also a spot in there that contemplates them doing their own independent qualitative analysis. It almost sounds like they might, come up with their own number, if you will. Review ACLs reported in the regulatory and other reports and reconcile them to your ACL estimates. So it's kind of interesting. So it specifically says that they're going to take your calculation and make sure it reconciles to the Carr report, essentially. Verify the models are subject to initial and ongoing validation, as we were just talking about, and assess the effectiveness of third-party risk management. So they're going to hit all points. I think it does say in there, and it says this for the board too, actually, when it's talking about peer data as it relates to the board, what they specifically say they don't want to see is an override by either the board or management to achieve a certain number for your allowance, whether that be a peer data or whether that be a budgeted amount. They don't want to see an override to get a specific outcome. They also say that regulators should not come in and recommend you come to a specific outcome. I will say that in the current guidance, the current FFIEC guidance, it says that as well, yet most of us, try to get to 1.25% or 1% or something like that. And we do it because our regulators have an expectation. So we'll see if that changes, and we'll see if how the regulatory process is. I don't know. We all number one, this is draft and it's not final, but we don't know for sure what the expectation is going to be. If we take this literally, I would say that there is a lot more. There's a high degree of enhanced expectation in and around documenting via your policies and procedures what you're doing, why you're doing it, and supporting your outcomes. And the requirement for an independent validation, it does not sound to me like your auditor signing your audit opinion on the financial statements as a whole, and that includes your allowance. Because number one, that opinion is not on your allowance; it's on your financial statements as a whole. I do think there will be the requirement for some type of relevant independent validation. But again, that doesn't have to be outside your organization if that skill set exists and you have the capacity to do it. So that covers the standard, and we're at 11:55, so a pretty good time. And I feel like I went very fast. There was a lot of information in there, so I apologize if I was running. Again, that's why there's a lot of data information on the slides so that you can reference it later. Certainly happy to field any. We'll field some questions in a minute or later if you come up with some. But so what I would say, I tried to come up with something that was really profound here on this last slide, but I couldn't really come up with anything. I would say this: you need to get to work, because I think you really need to be in a position truly where you run parallel in 22, if not 21, so you really know what you're looking at. I don't expect, this is, y'all gonna tell me I'm wrong later, but I don't expect a significant intervention from a regulatory body to delay this again. I think 23 is coming, and I think it's coming. You can play that game, but as the saying goes, denial is not a river in Egypt. And I think we need to just embrace CECL and get ready for it. And if somehow it doesn't happen and we enhance all of our documentation in and around the allowance, and we have a little bit better model than we had before, then we just all got better, and we improved our processes, and we refined in our allowance and gave it a higher level of precision. So there's an opportunity to get better. So I would say get to work if you hadn't already. Don't go it alone. There's a lot of advisors out there. You have some. You have internal auditors. You have external auditors. You have internal resources. You have consultants that you've dealt with in the past. Certainly engage those folks. Use their knowledge and let them tell you what they're seeing. And I would go back to the documentation standard. There's a lot of documentation in this. So it's more than just coming up with a calculation. That may seem overly easy, just coming up with a calculation, or that may seem like the only goal. The reason I say get started is because I think there's there's a lot of time that will need to be invested to meet these documentation standards as written. So I would encourage you to get to work. So again, the focus is on designing, documenting, and validating in this standard. In this statement. I keep saying standard, but hey, they're largely consistent, so they're the same. And there's our CECL roadmap. So we have time now. Let's see. This will be in your package. I won't go through the CECL roadmap. And then we also have partnered with a third party, and we'll give you some more information on that. But we do have a CECL dashboard that we're using that we can actually work with you on for implementation. And so we have a spreadsheet-based software that we can offer you, and we can also provide significant consulting around that. But I won't give you a sales pitch. It's just out there. And with that, we have a couple of minutes, literally, for any questions.
Okay, Doug, we've had several questions come through, and some I'm going to just let you respond to individually back to the person asked the question, but there's a couple that may be good for the entire audience. And the first one is, what do you think would be the regulatory expectations relative to CECL in the 2020 exam cycle?
Well, I would think that they would expect at this point for everybody to be moving in a direction. And I think for me, the starting point in a community bank or a credit union would be, who is going to own this? Is there a person who's going to drive the process? Or is it going to be by committee? Are you going to have a CECL committee? Now, certainly it's going to take a village to do it. But if there's an owner or a committee that you have in place, I think they want to see that you're going through the process. And I think their first question is going to be if you talk to your core provider about data. And I think you need to be able to answer that question in the affirmative, that you have talked about them and you know where you are on data at a minimum. So I think they're going to start wanting to see progress. They indicate that they're going to train their folks pretty significantly on the standard and the statement, and that they're going to come in your bank with a good working knowledge of topic 326 and this statement. So I wouldn't want to not be making progress when your regulators come in.
Okay, just one more quick minute. We only got like 30 seconds to answer this, but are community banks seeing significant increases in the reserves under CECL?
Yeah. Well, so most of the folks that have run parallel are SEC registrants, which does include community banks. There are some folks that thought they were going to have to do it, and then when the delay came, they determined they didn't have to do it, right? So they've got till 23. I would say on the whole, community banks that I've seen and the people I've talked to are not seeing significant increases. That's what I'm seeing. Now, might not be true of Bank of America and whomever else, but bread and butter community banks are not seeing a substantial increase in their allowance for credit losses based on the new methodology at this point.
Okay, well, that's good. Well, Doug, we're at the 11 o'clock mark, so you did perfect. And then do answer those couple questions that came in that you're going to have to answer directly. But anyway, that concludes our session. And thank you all for joining. And if any questions, again, Doug Mims is the presenter today, and his Contact information is at the back of the slide. Feel free to email him or contact him with any questions that you have, and he'll be happy to help you. So thank you and have a great day, and thank you again for attending this third CECL webinar.
Yeah. Thanks, everybody. Thanks, Phyllis.
Thank you, Doug.